In the ever-shifting landscape of global economics, a new narrative is emerging, one that could potentially rewrite the story of our post-pandemic recovery. As I gaze out of my Manhattan office window, watching the bustling streets below, I can't help but wonder a resp of a transformative moment in our economic history. The protagonist of this unfolding drama is surprisingly not a charismatic leader or a groundbreaking technology, but rather a commodity that has shaped geopolitics for over a century: crude oil. As the lifeblood of the global economy, oil's fluctuations have long weathered for economic health. But now, as we stand at the intersection of recovery and uncertainty, the black gold is offering a glimmer of hope. Picture this: Brent crude, the global oil benchmark, has dipped below $70 a barrel for the first time since late 2021. This isn't just a fleeting market blip. It's a seismic shift that could reverberate through every corner of the global economy. And if the crystal ball gazers at financial behemoths like Citigroup and JPMorgan Chase are to be believed, we might be looking at oil prices hovering around $60 a barrel by 2025. Now, I know what you're thinking. Brooks, why should I care about the price of oil? I'm not an oil tycoon or a commodities trader. But bear with me, dear reader, because this story is about much more than just the price at the pump. It's about the very fabric of our economic recovery, the battle inflation, and the delicate balance central banks are trying to strike. Let's zoom out for a moment and consider the bigger picture. For the past few years, we've been riding a roller coaster of economic uncertainty. The pandemic threw us into a tailspin, followed by a recovery that brought with it the ennui of inflation. Central banks around the world have been playing a high-stakes game of monetary Jenga, trying to cool down overheating economies without toppling the entire. Enter our unlikely hero: falling oil prices. Tim Drayson, head of economics at Legal and General Investment Management and a former UK Treasury official, puts it succinctly: the probability of pulling off a soft landing would increase. That applies to Europe as well as the US. In layman's terms, cheaper the lubricant that helps us glide into a more stable economic future, avoiding the dreaded hard landing that keeps economists up at night. But how exactly does this work? Well, it's a bit like a domino effect, but in reverse. Lower oil prices mean lower energy costs, which in turn help to cool inflation. This gives room to ease up on interest rates without fear of reigniting the inflationary fires. And here's where it gets interesting. Lower interest rates could potentially stimulate economic growth, creating a virtuous cycle that benefits everyone from Wall Street to Main Street. Of course, as with any economic forecast, there are caveats. The world is a complex place, and oil prices are just one piece of a much larger puzzle. We're still navigating choppy waters, with potential trade wars looming on the horizon and the specter of Chinese deflation casting a long shadow. But in a world where good news seems increasingly scarce, the prospect of $60 oil feels like finding aniseeds in the desert. Now, let's dive a little deeper into what this means for different players on the global stage. D states it a mixed bag. On one hand, lower oil prices could provide a much-needed boost to consumer spending. As Freya Beamish, chief economist at TS Lombard, points out, it would hand back purchasing power to the U.S. consumer. This could help shore up an economy that's showing signs of fatigue after its post-pandemic sprint. On the other hand, the U.S. is now a major oil producer, thanks to the shale revolution. Lower prices could put pressure on American oil companies, potentially leading to job losses in oil-producing states. It's a classic example of the economic principle that every action has an equal and opposite reaction. For Europe, the picture is a bit clearer. As a net oil importer, the old continent stands to benefit significantly from lower crude prices. The European Central Bank, which has been fighting an uphill battle against stubborn inflation, might finally catch a break. This could pave the way for more aggressive interest rate cuts, potentially breathing new life into the Eurozone's sluggish economy. China, the world's largest oil importer, finds itself in a unique position. Lower oil a welcome boost to its manufacturing sector, helping to offset some of the deflationary pressures it's currently facing. However, Asicia Garcia-Herrero, chief economist for Asia-Pacific at Natixis SA, is in structural deceleration. Cheaper oil alone to reverse this trend, but it could help soften the landing. For oil nations, particularly those in the Middle East and Russia, the prospect of $60 oil is less cause for celebration. These countries have built their economies and national budgets around much higher oil prices. A prolonged period of lower prices could force difficult fiscal adjustments and potentially lead to social unrest. Let's not get ahead of ourselves. The oil market is notoriously volatile, influenced by everything from geopolitical tensions to technological breakthroughs. The current price decline is driven by a combination of factors, including increased U.S. shale production and concerns about global demand. OPEC+, the cartel of oil-producing nations led by Saudi Arabia, has already implemented production cuts in an attempt to prop up prices. Whether these cuts will be enough to stem the tide remains to be seen. As we navigate this shifting landscape, it's worth considering the broader implications of cheaper oil. For one, it could slow down the transition to renewable energy. Lower oil prices make fossil fuels more competitive, potentially reducing the economic incentives for investing in clean energy technologies. This presents a dilemma for policymakers trying to balance short-term economic gains with long-term environmental goals. On the flip side, lower oil prices could accelerate the adoption of electric vehicles. As the cost difference between running a gasoline car and an electric one narrows, more consumers might make the switch. This could have far-reaching implications for the auto industry and urban planning. The geopolitical ramifications are equally fascinating. Oil has long been a tool of political influence, with producer nations wielding it as a diplomatic weapon. A world of abundant, cheaper oil could reshape these power dynamics. We might see a shift in global alliances and a realignment of strategic interests. As I ponder these possibilities, I'm reminded of a conversation I had with a cab driver on my way to the office this morning. John, a grizzled New Yorker who's been navigating the city's streets for over 3 decades, had his own take on falling. "It's great for my wallet," he said. "But I've seen ups and downs to know that what goes down must come up." John's street-level wisdom encapsulates the cautious optimism that many feel about this development. Yes, lower oil prices could be a boon for the global economy, potentially helping us navigate the tricky waters of post-pandemic recovery. But we must also remember that the economy is a complex, interconnected system. What benefits one sector or region may pose challenges for another. As we look ahead to 2025 and beyond, the prospect of $60 both opportunities and challenges central bankers. It provides a welcome tailwind in their fight against inflation. For consumers, it could mean more money in their pockets. For businesses, it could lead to lower input costs and higher profits. But perhaps the most important question is this: how will we use this potential windfall? Will we invest in infrastructure, education, and innovation to build a more resilient and sustainable economy? Or will we squander this opportunity, falling back into old habits and kicking the can of structural reforms further down the road? The answers to these questions will shape not just our economic future, but the very nature of our societies. As we stand at this cross, the possibility of cheaper oil on the horizon, we have a unique opportunity to reimagine our economics. In the end, the story of $60 oil is not just about numbers on a spreadsheet or fluctuations in a commodity market. It's about people, workers, consumers, entrepreneurs, and policymakers, all trying to navigate an uncertain future. It's about the hopes and fears that drive our economic and the complex web of cause and effect that connects us all. As I wrap up this, I'm reminded of a quote from the economist John Kenneth Galbraith. "The only function of economic forecasting is to make astrology look respectable. While we should approach predictions of $60 oil with a healthy dose of skepticism, we shouldn't dismiss their potential impact. Instead, let's view this as an opportunity for reflection and preparation. Whether oil prices fall to $60 or not, the very possibility should prompt us to think critically about our economic assumptions and priorities. It should inspire us to build more resilient economies, ones that can weather the storms of commodity price swings and geopolitical shifts. In the grand tapestry of global economics, the thread of oil prices just one of many. But as we've seen, it's a thread that, when pulled, can unravel or reinforce the entire fabric. As we move forward, let's keep our eyes on this thread, but never lose sight of the bigger picture. The story of $60 oil is still being written. How it ends will depend not just on market forces or policy decisions, but on our collective choices as citizens, consumers, and members of a global community. As we stand on the cusp of this potential shift, let's seize the opportunity to shape a more sustainable, equitable, and prosperous future for all. In the meantime, I'll be keeping a close eye on those oil price tickers, and so should you. After all, in the words of my cab driver John, What goes down must come up. But maybe, just maybe, we can use this potential downturn to build something better for when the inevitable upturn comes.